My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/BestStockStrategy. The Wealth and Health Podcast is brought to you by BestStockStrategy.com. The pros and cons of using margin when trading. David Jaffe with BestStockStrategy.com. In this video, you're going to learn the pros and cons of using margin when trading. This video should allow you to make a more educated decision on whether you should use margin or not. So let's get started. Regarding the pros of using margin when trading options, the first pro is that unlike with stocks, there is no margin interest that you'll need to pay when using margin. So unlike when you're trading stocks and you have to pay margin interest, when you're trading options, you do not have to pay any margin interest. The second benefit of using margin is that it provides much greater capital efficiency than not using margin. If you're not using margin, then you're going to have to use cash secured options. And as a result, the buying power requirements for those trades are going to be significantly higher. Additionally, because you're not using margin, you might be more tempted to choose more aggressive strike prices, because when you're using cash secured options, you're going to want to collect more premium to offset the buying power reduction. However, when you're using margin, then it will afford you an opportunity to go further out of the money and therefore decrease your risk. The third benefit of using margin is that it provides you with greater leverage and therefore the possibility of earning greater returns. The fourth pro or benefit of using margin is that it provides you with more flexibility. Remember, just because you have margin doesn't necessarily mean that you have to use it. You can enable margin on your account, whether it be regulation T or portfolio margin, and you don't necessarily have to use it. So simply enabling margin on your account does not mean that you have to use up all of your buying power. You can simply reduce your available buying power by the same amount that you would as if you were trading a cash secured option. Here are some of the cons or the disadvantages of using regulation T or portfolio margin. The first is that you're incurring greater risk. Remember, with the possibility of greater returns comes greater risk. Leverage is a double-edged sword and it cuts both ways. So while you have the possibility of earning higher returns, you are also incurring more risk. The second disadvantage and con of enabling margin is that human beings are inherently greedy and self-destructive. So remember, you know yourself best. So if you feel that you have a tendency to be a little bit of a gambler or to trade too large, then I would highly recommend that you do not enable margin on your account. The third con or disadvantage of margin is that depending upon the account that you're using and trading in, some retirement accounts, whether it be an IRA or a 401k, will not enable you to use margin. In those situations, oftentimes you can trade vertical credit spreads where you sell an option, and then if you're selling a put option, you would sell a short put and then buy a lower price put. Or if you were trading a call credit spread, then you would sell a call option and then buy a higher priced call option as protection. In summary, what should you do? Should you enable margin, whether it be regulation T or portfolio margin, or should you not enable margin and just trade cash secured puts or cash secured call options? In my opinion, I definitely think that you should enable margin, because remember, it is your choice whether you actually utilize that margin, and that as long as you show discipline and patience, you can simply reduce your available buying power by the amount that your account would be reduced if you were trading cash secured options. Additionally, and this is something that I haven't heard mentioned in other videos, I definitely think that by not enabling margin, you are encouraging yourself to be more aggressive with your strike selection. Whether that be trading straddles or trading at the money options, Instead, I would highly recommend that you trade out of the money options, collect slightly less premium, but also significantly increase your win rate when trading options. And one of the best ways of doing this is by using margin, because that will reduce your buying power reduction and therefore enable you to trade more underlyings and collect more premium. David Jaffe with BestStockStrategy.com. Please visit BestStockStrategy.com, enter in your email address, and receive over $400 of valuable free options trading materials. Please like, comment, share, and subscribe. Click the notification bell and let me know your thoughts below on whether you believe that using margin is beneficial or whether using margin is harmful. Visit BestStockStrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit BestStockStrategy.com and send me a message.